Fair value gaps are powerful trading zones that often cause the price to react, offering us great trading opportunities. However, if you trade every fair value gap you spot on the chart, you'll probably end up losing money. So what makes an FVG high quality and worth trading? To answer this question, we've backtested over 100 fair value gaps on the recent Euro-dollar chart to uncover the exact characteristics of those FVGs that actually move the market. In this video, we'll explain how to trade FVGs like a professional trader. Also, how can they be combined with other smart money concepts to enter high probability trades? So guys, if that's something you're interested in, as always, smash the like button to support us in making more videos like this, and subscribe if you're new. Starting with the basics. What are fair value gaps truly? A fair value gap, or FVG, is a price gap caused by a sudden imbalance between the strength of buyers and sellers. It's defined by a three-candlestick formation where we have a gap between the wicks of three consecutive candles like this. Now, what does the fair value gap even mean in terms of price action? As the name suggests, it simply means that there is a gap between the fair value of the price. The massive buying pressure has caused this aggressive movement, likely due to institutional activities, and now the price is inefficient. But what is the purpose of marking FVGs on the chart? These gaps represent inefficiency in price movement, meaning the market may later return to fill them as the price seeks equilibrium. Additionally, traders often use these gaps as key areas of interest, anticipating potential price reactions when the market revisits them. Here on the Euro-dollar 15-minute chart, notice how many times the price returned to the fair value gaps before continuing in the same bullish trend. This repeated retest of the zone suggests that the market is filling the imbalance before resuming its upward movement. Here on the pound-dollar 1-hour chart, the price returns to mitigate the bearish FVG created during the Asian session and then continues pushing downward. This rejection shows that the FVG acts as a supply area where the selling orders are located. When identifying these gaps, you have noticed that they come in different sizes. So here comes a question. Do larger fair value gaps act as stronger supply or demand zones? Not necessarily. While larger fair value gaps might look more significant on the chart, size alone doesn't determine their strength as supply or demand zones. Here's why. Larger FVGs often occur during periods of high volatility, like news releases or institutional moves. They can indicate strong momentum, but they might also be filled quickly and not hold as key reversal zones. Smaller, more precise FVGs, especially when aligned with other smart money concepts like liquidity grabs, break of market structure, or market direction, often lead to more reliable and cleaner reactions. So, while size can give you a clue about volatility, confluence is king when it comes to trading FVGs effectively. Now here comes the main question. What makes an FVG high quality and worth trading? Fair value gaps work best when they align with market structure conditions. When you combine them with key elements of SMC, they become powerful entry points with real precision. To identify high-quality fair value gaps, you need to focus on three key factors: market direction, liquidity, and the retracement levels. When these align with an FVG, that's where the real high-probability trades happen. So let me break down these three important concepts for you. Market direction. Who is in control? From the basic price action, we know that in a perfect trending scenario, the market makes higher highs and higher lows. Each time the price breaks above a structure level, it signals trend continuation, and a demand level automatically forms. Conversely, when it breaks below a structure, it signals a possible trend reversal. But the important thing you must keep in mind is the fractal nature of the market. Now, what does the fractal mean? It means that this uptrend formation can just be a correction in a higher time frame. So now that the price has tapped into a higher time frame supply zone, it has the power to change the direction in the lower time frame. Now we have a fight between supply and demand, and there is a high chance that the higher time frame will dominate and push the price lower. Once again, this could also be a correction on an even higher time frame, and the pattern may continue. That's why we always need to check higher time frames to identify market structure conditions within the bigger picture. It's common for traders to combine two or more time frames